What's up everybody, Yasin here and thank you for joining my channel. This is the part 2 of my video on the topic of how the banking system has been significantly structurally changed since GFC, also known as global financial crisis. So what I'm going to cover is what happened after GFC and how those changes are going to create even more inflation going forward. So pay attention to this because this information is not readily available elsewhere. You may have to dig through different articles, different blogs to find out what's happening behind the scene. I'm going to bring this to you in this small video so you can thank me later. Let's dive in. What's up everybody? So this is the whiteboard illustration of the post-GFC scenario. And before we go into this, I wanted to cover very quickly what happened actually in 2008. In my last video, I mistakenly said JP Morgan went bust, but it was actually not JP Morgan, it was Lehman Brothers who went bust. And what happened was, because as I explained that these banks, these commercial banks, they also lend money to each other. If they have a surplus, which is, more than what they have to keep in the reserve account, then they can overnight lend this out to other banks in the money market, or we call them repo market, and they charge interest on that money, which we call overnight rate, which is the actual interest rate that is set by central banks. So what happened in 2008, because there was a lot of rogue mortgages out there, and basically people have no jobs, no income, no proof of source of funds, and they were getting mortgages like left and right, and every person was going to have 1, 2, 3, 4, 5 properties at the same time, and there was a plethora of these rogue mortgages being lent out to the wider public in the US. So what happened was, then when Lehman Brothers needed some cash to operate themselves, and they wanted to loan out this mortgage-backed security collateral that they had, and nobody was willing to lend them any money because they knew that the collateral that they had, which is all of rogue mortgages, it was too risky, and the other banks in the money market, other lenders, they simply refused to lend any money to Lehman Brothers, and that was a result why Lehman Brothers went completely bust, because they did not have enough money to operate themselves, let alone to maintain the reserve account in the central bank, which is Federal Reserve. So that would happen. So bear with me, I'm going to explain what is fundamentally changed after GFC. So when this happened, there was a huge banking crisis, right? And the Central Bank of United States, Federal Reserve, came in and they intervened and they said, okay, let's figure this out and we will fix the situation. So what happened since then, they started a program called Quantitative Easing, or QE in short. And what that program was, basically central banks started purchasing government-backed securities. So as you can see, there is a few difference in this diagram compared to my last video, where you can see there's a ton of treasury bonds being purchased by central banks. So let me just show you here. So you can see in my previous video we had only one treasury bond being shown, which means there was a less amount of bonds being purchased. But here in the QE program, when they started in 2008, there was a ton of treasury bonds being created by government. The government was issuing all these 2 years, 5 years, 10 years, 30 years treasury bonds being issued, and there was just one buyer in the town, which is central bank, Federal Reserve, buying those bonds like crazy. And in return of purchasing those bonds, what they were doing, they were crediting a ton of money, a ton of dollars on government's reserve account in the central bank. So the government was getting a lot of billions of dollars of money in exchange of issuing these treasury bonds. Not only that, the central bank also started purchasing all those mortgage-backed securities, all those rogue mortgages that commercial banks accumulated over time, and they started buying those MBS. MBS means mortgage-backed securities, and in return they were crediting the bank reserve, which was net new dollars being created and credited into the reserve accounts that these commercial banks have with central banks. So a ton of or billions of dollars of credit being entered into the balance sheet, which was basically reserve account of these commercial banks in the central bank. So what happened then? The balance sheet of these commercial banks have expanded exponentially, and you can see here, this is the balance sheet of the commercial bank, which is showing that there is a ton of bank reserve being added onto their balance sheet, which means they have a huge capacity of issuing more loans. Okay, and as a result of that, they don't need these deposits anymore. Remember in my last video I told you that banks were competing with each other to collect more deposit as much as they can, because they wanted to increase the capacity on their balance sheet to issue more loan. And that's how they make money, because if they issue loan, they make money on the interest. Now they have a ton of reserves on their balance sheet, and central bank has flooded the commercial bank market with these exponential amount of bank reserves. So they don't need to compete with other banks to collect the deposit from the consumer, right? As a result of that, they don't need to pay this average Joe and Jane any interest on the saving, which is why for the last 13-14 years we are not seeing interest or are being paid on the saving accounts, because the banks do not need to do that, because they have a lot of capacity to issue new credits and new loans into the economy. Now the key thing here is, even if interest rate goes up, this will blow up the inflation bubble even furthermore. How? Let me show you. Alright, so let's assume the interest rate has gone up to 8%. Okay, what will happen? One theory is the commercial banks already have huge capacity on their balance sheet, right? Which means they don't need to collect deposit from the consumer, and they don't need to pay interest on their savings and checking accounts anymore, because they already have a lot of bank reserves, not only to maintain their account with the central bank, but also to lend more money out into the economy. So one theory is, when the interest rate goes up, which means these banks will make even more profit on these bank reserve and existing loans and mortgage-backed securities. Okay, so this will even incentivize these banks to even create more new loans into the economy. What will happen when you have more new loans created in the economy? It will jack up the asset prices, right? The asset bubble will further inflate, whether this is housing, whether this is car loans, whether this is stock market, hedge funds, whatever. If it incentivizes these banks to create more loans at scale, then of course it will further inflate the prices. Now, of course, I am not directly saying that it's going to increase the food prices, but when you have asset bubble created, then it creates a wealth effect. Okay, when it creates a wealth effect, it drives, it makes people spending more money. When they spend more money, then of course the consumer goods and services gets expensive, and that is the fundamental reason why we see the inflation will likely to go up. So what you're seeing here, this whole financial system is actually at the verge where the central banks cannot even do anything more to control inflation. even if they keep the interest rate low, as we have seen over the last 13, 14 years, it hasn't slowed down the inflation. Now, if they increase the interest rate, as every single guru economist is saying, then it will likely to further inflate prices up in the future. So that's one of the likely scenario. I'm not saying it's going to happen for sure, but the probability of having more inflation as a result of these banking policies is much higher. So I hope this is helpful. This information is not readily available. So if you like it, give me a thumbs up and hit subscribe, because I will continue pushing these videos on my YouTube channel. So don't forget to watch and share with your friends and families. Until my next video, take care.